In the world of income investing, finding quality companies trading for less than $20 is like finding a hidden treasure map. While the S&P 500 reaches new heights, a significant segment of the market, particularly high-yield stocks, offers a lower entry point for building substantial passive income. Why $20? For many investors, this price point allows for greater flexibility. You can buy more shares, facilitate easier diversification, and accelerate the process of dividend reinvestment. Today, we're going deep into the specific picks that stand out in April 2026 as the best high-yield opportunities right now. We are currently navigating a landscape influenced by shifting interest rates and sector-specific rotations. Real estate investment trusts and business development companies are offering yields significantly higher than the market average, providing a much-needed cushion against volatility. Our analysis today spans energy, utilities, finance, and consumer staples. Each sector carries its own risk profile, but the companies we've selected share a common thread: strong underlying fundamentals and a commitment to returning capital to shareholders. Let's start with a giant in the midstream space, Energy Transfer, trading under the ticker ET. Currently priced between $16 and $17, it remains a cornerstone for energy sector income. This isn't just another pipeline company. It's one of North America's largest energy infrastructure networks. Energy Transfer operates across every major domestic production basin. Their business model is largely volume-based. Whether oil is at $60 or $100, the fuel keeps moving through their pipes, and Energy Transfer collects a fee for every barrel and every cubic foot. This toll booth model provides incredibly stable cash flows. Currently, the distribution yield sits above 7%. For an investor, this means a predictable and high-yield return that is less sensitive to the daily fluctuations of commodity prices than exploration and production companies. Morningstar recently rated Energy Transfer with 4 stars, estimating that the stock is trading at a 20% discount to its fair value. This suggests that you're not just getting a high yield, you're also buying into a company with significant capital appreciation potential as the market realizes its true worth. However, keep in mind its structure as a master limited partnership. While it offers tax-deferred distributions, it also comes with a K-1 tax form. For many, this is a small price to pay for the level of income and stability ET provides in a diversified income portfolio. Moving to the utility sector, we find a unique opportunity in AES Corporation. AES is currently in a fascinating position, trading just under its $15 acquisition price. This isn't just about utility growth, it's about a guaranteed exit strategy. The company recently agreed to be acquired by a consortium led by global infrastructure partners in an all-cash deal valued at over $33 billion. For investors, this creates a merger arbitrage style of dividend play that is rare in the high-yield space. While you wait for the deal to close, expected later this year or early next, you can collect a dividend yield of nearly 5%. If you buy under $15, you're essentially getting paid to wait for a guaranteed $15 payout at the end of the road. This is a deep value utility play with a clear endgame. It offers a defensive cushion because the acquisition price acts as a floor for the stock. In a volatile market, having a stock with a fixed cash exit and a steady dividend is an excellent way to preserve capital while generating income. Next, let's talk about Rithm Capital, ticker RITM. Trading around $11 to $12, Rithm has evolved far beyond its roots as a simple mortgage REIT. Today, it's a global asset manager specializing in real estate and financial services. By diversifying into loan origination and servicing, Rithm has built multiple streams of income. This diversification is key because it makes the dividend much more secure than traditional mortgage REITs that rely solely on interest rate spreads. The yield here is staggering, currently sitting at over 9%. Despite the high payout, analysts believe the company's shift toward a broader asset management model provides the necessary earnings coverage to sustain these distributions for the long term. Rithm represents a high-conviction pick for those who believe in the resilience of the financial services sector. It's a company that's being proactive, not reactive, and investors are being handsomely rewarded with a nearly double-digit yield at a very accessible share price. In the healthcare space, Healthpeak Properties, ticker DOC, presents a compelling deep value story. Trading around $18 to $19, this REIT focuses on senior housing and life sciences, sectors with massive long-term tailwinds. The stock has lagged behind its peers recently due to lower than expected rent increases. However, this underperformance has pushed the yield up to over 7%. For the patient investor, this is a classic value play in a sector that is essential for an aging population. Morningstar currently views Healthpeak as a 5-star stock, estimating it trades at a 40% discount to its fair value. As senior housing occupancy recovers and life science demand remains high, the gap between the stock price and the underlying value of its properties is likely to close. Buying DOC under $20 gives you a front-row seat to the recovery of healthcare real estate. You get a 7% yield to wait for the turnaround, backed by a portfolio of high-quality, mission-critical properties that are hard to replicate. Not all high-yield stocks are in energy or real estate. Flowers Foods, the maker of household names like Nature's Own and Wonder Bread, is a rare consumer staples entry trading just under $20. It's a defensive play for your income portfolio. The stock hit multi-year lows as inflation pressured its margins, but its products are daily essentials. People buy bread regardless of the economic climate. Trading around 1985, it offers a yield of nearly 5% with a very reasonable valuation. In a recessionary environment, consumer staples like Flowers Foods act as a safe haven. Their steady, predictable revenue translates into steady, predictable dividends. It's the kind of boring stock that can provide a reliable anchor to a more aggressive high-yield strategy. For many, the ultimate goal of dividend investing is monthly cash flow. Several high-yielders under $20 fit this profile, allowing you to align your income with your monthly bills. But beware, high yield can sometimes mean high risk. Take AGNC Investment Corp, trading near $10. Its yield often fluctuates between 13 and 14%. It's a powerhouse in the mortgage REIT space, but its sensitivity to interest rate movements makes it a more volatile choice for conservative investors. Prospect Capital, or PSEC, trades at around $6 and yields over 16%. As a BDC, it lends to middle-market companies. While the income is massive, keep an eye on management fees and credit quality, which are critical for the sustainability of such a high payout. Horizon Tech Finance is another monthly payer, yielding near 17%. They specialize in financing venture-backed technology companies. This is a higher risk play, but for those under $20, it offers exposure to the growth of the tech sector with a significant income component. A particularly interesting emerging opportunity is the MSC Income Fund, ticker MSIF. Managed by the legendary team at Main Street Capital, this fund listed recently and is trading around $13 with a yield of over 10%. MSIF mirrors the successful strategy of its parent company, but trades at a significant discount to its book value. For investors who want Main Street quality at a sub-$20 price, MSIF is a compelling option for both income and potential capital gains. Investing in high-yield stocks under $20 isn't without its challenges. The primary risk right now is interest rate sensitivity. When the Federal Reserve shifts its stance, REITs and BDCs are often the first to feel the impact on their cost of capital. Always look at the dividend coverage ratio. A company paying out more than it earns is a red flag. For stocks like AGNC, the high yield is attractive, but the margin of safety is thinner than a company like Energy Transfer or Flowers Foods. Taxation is another critical factor. REIT dividends are often taxed as ordinary income, which can take a big bite out of your net returns if held in a taxable account. Always consider holding these in a tax-advantaged account like an IRA. For master limited partnerships like Energy Transfer, the tax rules are even more complex. You'll receive a K-1 instead of a 1099. While this offers tax-deferred income, it also adds complexity to your annual filing. Consult with a professional to ensure it fits your situation. How do you build a portfolio with these picks? The key is diversification across sectors. Don't just load up on 10% yields in the financial sector. Balance your high yielders with defensive staples and stable energy infrastructure. By spreading your capital across Energy Transfer, AES, Rithm, and Flowers Foods, you create a resilient income engine that can withstand shocks in any single sector. This balanced approach is the hallmark of a successful long-term income investor. To summarize, look for deep value in Healthpeak, stability in Energy Transfer, and merger-protected yields in AES. These stocks prove that you don't need a massive share price to generate a massive income stream. As we move through 2026, keep a close eye on interest rate trends and corporate earnings. High-yield investing requires constant vigilance, but the rewards of a growing passive income stream are well worth the effort. Your next step is to research these tickers individually. Check their latest quarterly reports and ensure their strategy aligns with your personal risk tolerance. the best investment is one you understand and believe in for the long haul. Building wealth is a marathon, not a sprint. By focusing on quality dividend stocks under $20, you are laying the bricks for a secure financial future. Thank you for joining us today, and happy investing.